back to our year-end mutual fund cafe. I'm speaking with four of the top-most mutual fund managers, managing between them practically half the total assets under management in the Indian mutual fund industry. Prashant, to start where we left off our conversation with Sunil, what's your sense in terms of earnings growth? We have seen this meandering in the low single digits. What might we end FY16 with? What might FY17 hold?
I think if you look at last 4 or 5 years, corporate margins in India have come down very sharply. So Sensex EBITDA, which used to be about 22% is hovering at a 17-year low. It's fallen to about 16%. And there were many reasons for that, but I think all these reasons are getting corrected now. And I would say next few years should be very exciting for earnings growth. And the trouble is we want to forecast it on a quarterly basis, and I don't think that is feasible. But I think if you look at next 2-3 years, I would be very optimistic on profit growth, because the inflation is off, commodity prices are sharply off. The banks, I think, should see a very good, healthy improvement in profitability. Even in the current year, some of the larger banks are seeing very good improvement in profitability, and I think that trend should gather momentum. Commodity cycle may or may not, prices may not go up, but I think it should cease to be a drag on the profitability. And I think finally we are in transition. The biggest downgrades in earnings have happened. Some of the biggest downgrades have happened in the consumer staples and the pharmaceutical sectors.
That's true.
And I think going forward into next year, I mean, even that will probably hopefully cease to be a drag. Last time when corporate margins were at, when they were at current levels, I think was in 2003.
Yes.
And next 5-6 years saw almost between 20 and 25% CAGR growth in profits. So I think we should see above nominal GDP growth in profits starting next year, and that trend should gain in momentum for the next few years after.
Oh, the trouble with this last part of your sentence is that this time we don't seem to be on the verge of a global recovery, at least as of now. And nominal GDP now, because of the curbs on inflation, is probably not going to be more than 8%, even going by the government numbers. In any case, just to come back
Why
to...
nominal GDP should be 12%, right?
No, they are now working at 8% because they are working with deflation. Only because of deflation. But anyway, that's an arithmetic issue. You know, for the past couple of years, we have been starting with probably 15% earnings expectations and ending up with 5 or 6. Will FY17 be the double-digit year for earnings growth?
I think so.
Will we make it to 15 or something, you think?
I think, let me put it this way. I think these markets in economy are in transition, in my opinion. And sectors which have delivered very high earnings growth in last 2-3 years, they will see a slowdown.
Okay.
And this could be consumer staples, could be pharmaceuticals. Even IT services is slowly becoming a bigger and a more mature business. But I think the domestic-centric businesses should start delivering very high and good profit growth starting next year.
So that would be what, largely banks?
I think banks continue to drive profit growth, and I think as asset quality pressures are, somewhere stabilizing or peaking out, I think that will flow through very strong earnings over next 2 years whenever the provisioning costs moderate. I think commodities will cease to be a drag. Consumer discretionary like automobiles could see healthy growth rates. Even cement, someday the cement prices the profitability should improve.
In FY17?
See, that is the trouble with forecasting cement prices. So inherently I think most equity investors are optimistic.
Yes.
So we therefore start off saying it will happen, but it does not happen that year. But I would again come back and say the same thing. If we take a 2-3 year view, I think earnings will surprise us on the upside and not on the downside.
What's your guess, Navneet, in terms of earnings?
So I think
FY17.
what has depressed them is like commodity prices, some of the global companies more linked to the global demand side, also the cross-currency currents in case of some of the exporters, the depression in the rural earnings, and also all the NPA issues, asset quality issues with the banks which have dragged down the overall earnings. Some of these are cyclical, some of these are structural. I think the cyclical issues would be behind us, and I agree with Prashant. I think we will have a stronger recovery. The base has got formed, I think, which is pretty low as you mentioned, and I think on that base we can have a pretty good growth over the next couple couple of years. There are all the signs apart from the ones that he mentioned about the passenger car sales, or when you look at the indirect tax collections, airline traffic, you look at some of the job indices. So there are a couple of indicators which are indicating that urban consumption is reviving. With the increase in the government spending, particularly on the irrigation and the infrastructure, I think even the rural demand is likely to, I think that's also bottoming out. Those will, I think, support the consumption, and as the government spending picks up, overall investment cycle is better. The global environment starts improving. So when you have a very low base in some of these globally impacted companies, on that I think a 15% earnings growth for next few years is quite likely. But you must remember that I think some of the companies will get hit by more structural issues, maybe that we can discuss separately. I think some of the sectors will have a serious challenge for a long time. The guys who have made a lot of money over the last couple of years as a way of doing business changes will have to keep that in mind, how that depresses the earnings, and how some of the new sectors are the ones which basically lift the overall earnings for the corporate India as a whole.
I will, actually disruption is going to be my big theme for the next, after the break, but just one word from you, Naren, will this be the earnings breakout year, FY17 or calendar 2016?
Actually, my view is that earnings is going to be a lagging indicator. If you look at it, if you bring down earnings primarily because of commodity price fall, and then today do you wish for $100 oil to drag up commodity earnings and say earnings has come back? I think if all the commodity price falls, there's a set of stocks whose earnings are going to crash. That's what happened this year. So I think we should focus on whether the NPL issues in the banking system get resolved, whether you're able to get the real estate sector into a deleveraging cycle. I think if these two happen, automatically after some time earnings will pick up and markets will reward before the earnings pick up. So I think if you ask me, what we are looking for is not whether earnings pick up. First of all, if you look at it as a country becomes more efficient, people equate to 2002 to 7 cycle. In that cycle, most mines were given free. Now most mines are auctioned. Most of the spectrum was given very cheap. Now the spectrums are auctioned. So I think to expect the same level of margins when your efficiency of an economy is much higher today in many sectors, thanks to disruption and many other reasons. So I think earnings is less worrying for me. What worries me is that the NPL issue is not getting resolved. The real estate sector is seeing very low traction and the sector is yet to, there's no price drop. People are just holding on to
15% earnings growth is going to be tough. Is that your base case?
I think it's not material for me if real estate manages to deleverage very successfully and infrastructure and metal NPL issues become smaller. I think automatically markets will go up, then earnings will pick up.
Okay. Your take, earnings finally around the corner?
I would be in the camp of Prashant. I definitely think that earnings should pick up in 2017. And the sales growth might not be as robust because obviously you have inflation which is much lower, but the operating leverage as well as the financial leverage. Operating leverage because of higher capacity utilization and lower costs, and financial leverage because of lower interest cost. I think both of those should play. And we go by history. So in 2002-03 the scenario was very similar. The markets went up first and then the earnings growth actually started from 2004 and 5. I think this time also it's no different. Yes, we would have loved the earnings to kickstart maybe in the June quarter, but it's fine, it's delayed, not denied. So we would definitely be in the camp of earnings growth of upwards of 15% in the next financial year.
Well, this is the first edition of our Mutual Fund Cafe. Stay tuned. We will come back with a second edition of our Mutual Fund Cafe with the top fund managers of India.
And going forward, in my opinion, the investment-led sectors should outperform the consumer and the export-led sectors.
I don't think FIs have left, and they would definitely be there.
If you want shorter periods of time, invest in hybrid funds, you will get good risk-adjusted returns.
You don't get returns in a linear fashion. So over the next couple of years, it should be 12 to 15%, which on a risk-adjusted basis relative to other asset classes look very attractive.